You saw it. That glorious green candle shooting for the stratosphere. Your Bitcoin balance, once a humble digital acorn, now looks like a mighty oak, possibly with a Lambo parked underneath it in your daydreams. Champagne wishes and caviar dreams, right? But hold on. Before you quit your job and commission that solid gold statue of Satoshi, there's a shadowy figure lurking just beyond the glow of your crypto gains, an uninvited guest to your moon party, the taxman. What if those spectacular profits could violently deflate, or worse, summon a very unhappy letter from the authorities, all because of a few crucial, often misunderstood rules? Forget deciphering complex white papers. We're about to navigate the far more perilous labyrinth of Bitcoin taxes. The essential secrets to safeguarding your crypto wealth and keeping your financial house in order are about to be unleashed. First things first, let's shatter a common illusion. To your friendly neighborhood tax agency, Bitcoin and its crypto brethren are not treated like the dollars or euros in your bank account. In most major jurisdictions, think the IRS in the US, HMRC in the UK, and similar bodies worldwide, cryptocurrencies are generally classified as property. This isn't just boring tax jargon. This fundamental classification is the master key that unlocks, or locks you into, everything about how your Bitcoin activities are taxed. It's more like owning stocks, bonds, or a rare Beanie Baby collection than holding cash. Now, let's talk about the main event, the headliner of your potential tax bill, capital gains tax. This is the taxman's cut whenever you sell, trade, or otherwise dispose of your Bitcoin for more than you originally paid for it. That original cost being your cost basis. Think of it as a profit-sharing scheme you never consciously signed up for. The real kicker? The tax rate on these gains often hinges dramatically on how long you held onto your Bitcoin before parting ways with it. We have short-term capital gains. This applies if you held your Bitcoin for less than a year. This time frame can vary slightly by country, but a year is a common benchmark. Profits here are typically taxed at your ordinary income tax rate, the same rate as your salary. Depending on your income bracket, this can be a painfully high percentage. Ouch. Then there's long-term capital gains. This is the golden ticket. If you held your Bitcoin for more than a year before selling, your profits are usually taxed at significantly lower, preferential rates. This is the tax code practically screaming HODL at you. Calculating this gain or loss is, on paper, simple. Sale price minus your cost basis. Your cost basis? That's the price you paid for the Bitcoin plus any transaction fees associated with acquiring it. This is where meticulous, almost obsessive record-keeping graduates from a good idea to an absolute financial lifesaver. But here's the real minefield, the place where countless crypto adventurers unknowingly plant tax penalty flags. Taxable events. It's not just about cashing out Bitcoin for good old fiat currency like dollars or pounds. Oh no, the taxman's definition of disposing of your property is far broader and far more eager. Trading Bitcoin for another cryptocurrency? Say, swapping some BTC for the latest hot altcoin? Ding! Taxable event. You've sold your Bitcoin, and its fair market value at that moment is your sale price. Using Bitcoin to buy goods or services. That fancy new gaming rig, that online subscription, even that legendary and probably very expensive pizza you bought with Bitcoin. Ding, ding, ding. Each purchase is a taxable event, a disposal of your Bitcoin property. What about earning crypto? If you're mining Bitcoin, those newly minted coins are generally considered ordinary income, valued at their fair market value on the day you received them. Same goes for staking rewards. And yes, when you later sell that Bitcoin, you could also owe capital gains tax on any appreciation since you received it. It's the gift that keeps on taxing. Airdrops? Hard forks? Generally, when you receive new coins and gain dominion and control over them, that's often treated as ordinary income at their fair market value at that time. Getting paid your salary in Bitcoin? That's income, taxed like any other paycheck. What's not usually a taxable event, you ask, desperately seeking a loophole? Simply buying Bitcoin and holding on to it, hodling, is generally fine. Moving your Bitcoin between your own wallets or exchange accounts. Usually okay. Donating Bitcoin to a qualified registered charity can actually be a very tax-efficient move, potentially allowing you to deduct the fair market value without realizing the capital gain. Gifting Bitcoin is also possible. though gift tax rules apply above certain thresholds. And crucially, the lucky recipient usually inherits your original cost basis, so they'll face the capital gains tax when they eventually sell. So you've had a few taxable events. Now what? You report them. Tax authorities worldwide are no longer treating crypto as some untraceable internet funny money. They are actively receiving data from exchanges. In the US, for example, you'll likely be using Form 8949 to detail each transaction and Schedule D to summarize your capital gains and losses. Many countries now have a specific question on their main tax form asking if you've transacted in virtual currencies. Answering that untruthfully is generally a very, very bad idea. Think perjury, with a side of hefty penalties. Ignoring your crypto tax obligations can lead to a world of pain. Back taxes, eye-watering interest, substantial fines, and in egregious cases of deliberate evasion, even criminal charges. This isn't a game of hide-and-seek you want to lose. Your ultimate shield and sword in this battle? Impeccable record-keeping. You absolutely need to track the date of every single transaction, the type of transaction, buy, sell, trade for another crypto, used to purchase goods, the specific cryptocurrency involved, the amount in crypto, the fair market value in your local currency at the precise time of each transaction, any transaction fees paid. These can often be added to your cost basis or deducted from proceeds, and details of the other party if it's a direct trade or payment. Crypto tax software can be a lifesaver here, helping you import transactions and calculate gains. Spreadsheets work if you're diligent. Most exchanges allow you to download transaction histories, but don't rely on them to hold your data perfectly, formatted for your tax needs, forever. Download regularly. Backup everything. Now for some potentially good news, strategies to legally minimize that tax bite. First, as mentioned, HODL for the long haul. Aim to hold your Bitcoin for over a year to qualify for those sweeter long-term capital gains tax rates. Patience can literally pay. Second, tax loss harvesting. Got some crypto investments that are currently worth less than you paid? Selling them crystallizes that capital loss. This loss can then be used to offset capital gains from other crypto trades, or even gains from stocks. In some countries, like the US, if your losses exceed your gains, you can often deduct a certain amount, e.g. $3,000, against your ordinary income per year, and carry forward any remaining losses to future years. One caveat: be aware of wash sale rules if you're selling and quickly repurchasing securities to harvest a loss. While the direct application to crypto is still a gray area in some jurisdictions, treading carefully or waiting a period before repurchasing. The same crypto is a prudent approach. Third, tax-advantaged accounts. Depending on your country, there might be ways to hold Bitcoin exposure, often through regulated products like ETFs or trusts rather than direct holdings, within tax-sheltered retirement or savings accounts, like self-directed IRAs in the US or ISAs, SIPs in the UK. The rules are complex, evolving, and highly jurisdiction-specific. Fourth, specific ID method. Instead of the default first-in, first-out FIFO accounting method, if your records are pristine and your exchange or wallet supports it, you might be able to use specific identification. This means you choose which specific batch of Bitcoin you're selling. For example, if you bought BTC at 10K, 30K, and 60K, and the current price is 50K, you could choose to sell your 60K BTC to realize a loss, or your 10K BTC to realize a large gain, perhaps if you have losses to offset it with. This requires next-level record keeping. What if you're listening to all this and a cold sweat is forming because you haven't been doing any of this? Deep breath. Don't stick your head in the sand. Many tax authorities offer voluntary disclosure programs or ways to amend past returns to get compliant. The penalties for coming forward proactively are often far less severe than if they discover the omission themselves. And this leads to the biggest, boldest, flashing neon sign disclaimer of them all. Tax laws surrounding cryptocurrency are a complex, rapidly evolving beast. What's true in one country can be wildly different in another. What's true today might be updated by new legislation or court rulings tomorrow. This information is for general knowledge and entertainment only. It is absolutely not financial or tax advice. For the love of all that is HODL, Always consult with a qualified registered tax professional, CPA, or chartered accountant in your specific jurisdiction who has demonstrable experience with cryptocurrency taxation. They are the only ones who can give you advice tailored to your unique situation and the specific laws you are subject to. Investing in their advice could save you vastly more in the long run.